Thank you for the introduction, Peter. It's my pleasure to take this opportunity to talk about accounting for carbon credits at this year's Accountability in a Sustainable World Quarterly Conference. Let me jump right into the main topic here, which is really the issue of how can we manage the carbon transition to a net zero world in time. I'm reproducing here on this first slide a picture that the International Panel on Climate Change first produced. I've modified it a little bit. The point of this slide really and this picture is to show how the world could, over the next 35 years, roughly, get into a position where at the end of the day, global carbon emissions are coming to a net zero position. And furthermore, the total emissions along the way would not exceed what climate scientists tell us is our carbon budget, nowadays roughly 600 gigatons, if we want to have at least a 2/3 chance of keeping global warming to below 1.7 degrees Celsius. One of the things you see on this slide is there are green bars, and they denote the negative carbon emissions, and they would be balancing out the positive carbon emissions by the year 2050. The immediate question is, who would pay for these negative carbon emissions? This would basically be the task of cleaning up the commons in terms of our greenhouse gas emissions, and who will have an incentive to pay for those and make those happen. That's really where we come to the whole topic of carbon accounting. If we look at this at the firm and corporate level, we have all heard about so-called net zero pledges, where companies are saying we will be carbon neutral by the year 2050, very much in line and in accordance with the picture you just saw. Companies also increasingly provide measures of their own corporate carbon footprint, in terms of their overall emissions, but also their individual product carbon footprints. I will abbreviate these as PCFs here in the future. Furthermore, to the point of a net zero position, some consumer product firms, in particular in Europe, have gone a step further and have said, well, we already supply really carbon neutral, net zero products to you today. I think the general reaction by the public has been somewhat skeptical to that. It's understood that this is only possible if companies rely on so-called carbon offsets. That is, they're basically including negative emissions in their measures of their product carbon footprints. This brings us all sort of to a question of, can we trust these numbers? Do consumers, does the public, do investors trust these numbers? What's missing here still is really a broader framework of generally accepted accounting principles for carbon, similar to what we have in financial accounting. And the talk that I want to give here today is really going to make a few suggestions of how we can go further along the lines of what we have done successfully in the area of financial accounting to create additional credibility in these matters. When companies do procure so-called carbon offsets, they typically turn to the voluntary carbon markets. This is an interesting sort of phenomenon that has sprung up in recent years. It has grown very rapidly. You see here on this slide that McKinsey estimated that in the year 2023, last year, the median price came down to $4 per ton of CO2. That is, of course, a remarkably low figure, and immediately raises the question, do we still have really a lot of cheap opportunities for these carbon offsets? I refer to them here as low-hanging fruit. Or is there simply also a bunch of very questionable offsets that are being included and traded? Mind you, at the same time, we do have also the phenomenon that there are some very high-end offsets that are trading above $500 or even $600 per ton of CO2. So that keeps basically all of us a little puzzled as to what's going on in these markets and how can we really properly distinguish between high and low quality offsets. One other thing to distinguish here early on, in particular for the purposes of my presentation, is the distinction between a so-called avoidance and a removal offset. With an avoidance offset, the logic typically is because one party interfered, paid for something, another party did not emit CO2. So the classic example is a forest that was not burned down because of the intervention of the party buying the offset, and therefore the emissions were avoided. Typically, these are based on counterfactuals. They also usually, or frequently at least, result in double counting. In contrast, removal offsets are far more direct and verifiable. It typically involves an activity where somebody says, through my action, so many tons of CO2 were removed from the atmosphere. So that typically avoids this whole counterfactual line of reasoning. Let me give you on this slide a little bit of an overview of what we have at this point in the world of these removal technologies. So I abbreviate them throughout the remainder of the talk as CDRs, carbon dioxide removals or removal technologies. And in this picture here that I've reproduced from a journal article from a number of years ago, you see some of, in the top row, you see some of these common technologies like reforestation, familiar to all of us. You also see things like BICS, bioenergy with carbon capture and storage, where basically biomass is being combusted to generate electricity, and then the CO2 is being captured and ultimately stored and sequestered underground. You see also another CDR technology there in the next block. This is direct air capture that has received a lot of attention, and other opportunities. It's important when you look at this top row to sort of keep in mind that some of these are really the capture part is being done by nature. Those are sort of denoted here in gray and the lighter color. That is, photosynthesis is doing the capturing part, as opposed to the engineered part, which is called chemistry here, in the case of direct air capture, where we're using basically some kind of filtration device. If you look at the bottom of this slide, you see there are different possibilities to ultimately store the CO2. It can be stored above ground, as we would do in a forest or in the soil, but it could also be stored permanently in the ground, particularly attractive in connection with direct air capture, or even in the ocean. So in discussing the quality of different CDRs, frequently analysts refer to two criteria that are important when it comes to the quality of such a removal. One is the additionality, typically not an issue for really the type of technologies that I've seen, that I've shown here, but much of an issue for the avoidance offsets. The other one is the issue of permanence. In other words, can we guarantee that the CO2 is taken out of the atmosphere and removed from the atmosphere permanently? And this, of course, then brings out the immediate questions for how should companies account for these CDRs if they acquire them? Should they only recognize permanent and irreversible CDRs? And if so, should they have discretion in applying these credits to individual product carbon footprint measures, something they probably very much would like to do because they would like to advertise these products as having these features. So if I now sort of take a little bit more of a normative step and say, well, how could accounting for these CDRs really be embedded in a system in which we keep track of our corporate and our product carbon footprints? You see here what I call a carbon emissions flow statement. This is something that more and more companies are doing when they're tracking the product carbon footprints of individual products, typically by looking at their Scope 1 emissions, Scope 2, and all the upstream Scope 3, that is all the emissions that have been accumulated in the supply chain. If you then add this up, you get to an aggregate measure of carbon emissions in goods sold, very much in analogy to cost of goods sold. So the idea here is that we're building up a measure of what the firm's carbon footprint in a particular year was as the aggregate of the individual product carbon footprints and, of course, the sales quantities of these goods. If we want to go down the route of saying companies should have discretion in including the CDRs, the removals in products, then these CDR credits are being assigned, and I'm not showing this here, but this you can imagine companies sort of doing this as part of the accounting system of including these numbers in these PCFs. At the end of the day, we then get a measure of damage done to the global climate, which takes into considerations the three scopes as well as the negative emissions that the company contributed. So let me show a corresponding balance sheet for this income statement, this flow statement. And here I'm drawing on some earlier work that I actually presented to this conference last year. The idea that we keep track of the emissions in our operating assets over on the left-hand side of this balance sheet. And on the right-hand side, we're keeping track of direct emissions removals and a measure of equity. The idea now of the direct removals, as you can see here, are going in with a negative sign. That's why I put it in parentheses. So as we are running through an operational cycle and we're debiting work in process and goods with the emissions that are being incurred, we're at the same time reducing these emission counts by any removals that the company has been acquiring. At the end of the day, then there is the CE flow measure, this income measure, and that in turn flows into our equity account. So the equity account really at the end of the day is a measure of cumulative emissions, legacy emissions if you want to, and it reconciles with the income statement. So that's what I've just described to you is one way of incorporating carbon dioxide removals into a corporate carbon accounting system. But of course, there are alternatives. And what I want to do in the remaining time is to outline a little bit what I perceive as trade-offs, depending on how one wants to choose the accounting rules and how much credibility one gets with different ways of doing these things. So in what I discussed thus far, I haven't really told you how this allocation to different product carbon footprints happens. It could be that the company has full discretion. Critics have said that is too much greenwashing. So if Shell, the oil company Shell, for instance, tells us that they're selling us carbon-free gasoline in some country, they may have done so by selectively applying these credits to gasoline sold in a particular location in the world. And is that sort of appropriate, or should there really be more restrictions on it? One way to go about this and to basically sort of guard against this charge of greenwashing is to say, well, let's really break this out in a different way, where we're saying we have product carbon footprints calculated in the way companies are already doing, that is Scope 1, 2, and upstream 3, but we are not including the current CDRs in that product measure. Instead, we're breaking it out, as you see here in my new flow statement, as a separate line item. So for the accountants in the audience, this should probably feel very natural. What we're saying is Current CDRs are not an inventoriable cost, but they're being really treated as a period expense, much like SG&A. The total CE flow measure would still be the same at the end of the day, but to an analyst, a reader, the public, it would be apparent that a lower CEO flow measure has been made possible really through the acquisition of these carbon dioxide removals, as opposed to the company mitigating its emissions in its production process. Let me, in the remaining time, bring in one last idea, and that is the question, do we only recognize permanent removals? This is something that has been postulated and asked for by some people in this debate. On the other hand, as I showed you early on, some of the less expensive removals that are available to the world really may not have that feature that we can guarantee that the carbon is permanently, that is for hundreds or even 1,000 years, removed from the atmosphere. What do we do then? So here again, an accounting approach that looks at stocks and flows, in particular at balance sheets and flow statements, gives us some flexibility. What I'm showing on this slide here is the idea that we may identify some of these removals as being potentially reversible within the next, say, 500 years, to give an example. It could be 100 years. If so, we are basically treating them differently from the ones where we are sure that we have sequestered it geologically for sure for 1,000 years. So this is the idea that, again, from financial accounting is relatively common, the idea of a contingent liability. In this case, I call it a contingent CDR liability here. What we're saying basically is it's a conservative approach and says for as long as it's not sure and it hasn't been proven that this has been really withheld from the atmosphere, we're building in this contingent liability and account for this correspondingly then also in our current measure of income in the CE flow measure. That makes a lot of sense if we really have a commitment in terms of the reporting and also the audit process to follow over time what has happened to these emissions. So this is here I'm basically doing now part 2 of the story I just told you, in that we're saying we track this over time and basically at each point in time verify that indeed so far this has held up. In other words, that the carbon dioxide, the forest that we grew, that we reforested, did not burn down, and so the carbon continues to be stored and more carbon continues to be stored. Then we don't have to do anything until we reach the time that we made the promise for, which I refer to here as capital T in this slide. On the other hand, if something really does go wrong, in other words, it does not hold up, and we have a re-release of this, then we, just like in financial accounting, we know how to deal with such a contingency. Basically, the bad thing happened, and we would then record fewer direct removals and remove this contingent liability. And I'm playing this through here in the different variants that some may go through perfectly as planned and others may reverse themselves, what we would do then in those contingencies. All of this, of course, requires a commitment mechanisms where companies say, yes, there are some of these removal technologies that are in play, and they are, we cannot guarantee that they will work, but we can guarantee that if they don't work, we will follow up, and this will be reflected in the numbers that we are reporting in our annual carbon emission statements. Okay, that brings me really then to the close in this. Carbon credits, in particular, so carbon removals, in my mind, are going to be an important tool to limit the most severe effects of climate change. corporate carbon accounting, properly done, can make these efforts far more transparent and can hold companies accountable for what they're doing in this space. I have here focused specifically on the two questions. Should we really restrict attention only to carbon dioxide removals that are permanent and irreversible under any circumstances? Or can we be more flexible if we have the appropriate accounting concepts and background and institutions in place? The other question is the one about discretion in assigning these credits to different sales products. Giving companies discretion is probably a more powerful tool in terms of creating incentives to acquire these costly credits in the first place, because companies would like to advertise the product as being low carbon or even carbon free. On the other hand, if we want to be more transparent in terms of what has been happening about the acquisition of these credits, it may be important to put limits on that discretion, but that may be, from an incentive perspective, then also weaken the incentives to acquire them in the first place.